over net credit sales times 365. Days sales outstanding, average accounts receivable, over net credit sales times 365. Days sales outstanding, average accounts receivable, over net credit sales times 365. Days sales outstanding, ending accounts receivable, over net credit sales times 365. Days sales outstanding, ending accounts receivable, over net credit sales times 365. Days sales outstanding, 365, over accounts receivable turnover. Days sales outstanding, 365, over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365.
Welcome again to our study time. It is a beautiful day. Today is Tuesday, the 23rd? 23rd. Let's keep going. Father God, thank you for this beautiful day. Thank you, Lord, for your mercy that renews every morning. Thank you for giving us the opportunity to be back here again to study. We ask you, Lord, for intelligence, for knowledge, for wisdom and understanding. Give us the capacity to understand difficult ideas, and also give us the capacity to explain it to other people in a simple way so that they can understand. Lord, bless us. Forgive our sins, we pray in Jesus' name. Amen. All right. Today we are attacking a new chapter, cash and cash equivalent. What I notice is that every time I'm attacking a new chapter, I need a buffer after the old chapter. We just finished the ratios. It was heavy, but at the end it became really fun. So let's go ahead and start attacking cash and cash equivalent. Okay. We are currently studying cash and cash equivalent. I need the foundational knowledge that are necessary to dominate this chapter. The things that I need to know, things that I need to learn, help me understand this chapter. Okay. For far, the cash and cash equivalent chapter is really about answering one question. How much cash does the company actually have available? Okay. So that's the question we're answering in this chapter. For the cash and cash equivalents chapter, the cash and cash equivalents chapter is really about answering one question. How much cash does the company actually have available? Everything else in the chapter flows from that. What is cash? Cash is the money that is immediately available to spend. Example, currency, coins, checking accounts, demand deposits, petty cash. Petty cash. Think cash equals spend it today. Cash equals spend it today. What are cash equivalents? Cash equivalents are investments that are almost cash. Requirements, they need to be short term, highly liquid, easily converted to known cash amount, very little risk of value changing, or very little risk of value changing. The big rule, original maturity of 3 months or less when purchased. Examples, treasury bills, money market funds, commercial paper, less than 3 months, short-term government securities. Quick fire test trick. Ask, can I turn it into cash almost immediately without losing money? If yes, it is cash equivalent. If no, it is investment. What is not cash equivalent? Example, stocks, corporate bonds with maturity over 3 months, certificates of deposit over 3 months, long-term investments, accounts receivable. Restricted cash. Restricted cash is cash that cannot currently be used freely. Examples, loan covenant requirement, security deposit, construction fund, sinking fund. Example, company has cash $100,000, restricted cash to $20,000, total cash resources $120,000, but unrestricted cash available is $100,000. Far favorite question. Can restricted cash still be cash? Yes, it's still cash. It is simply restricted. Bank reconciliation. This is the most important topic in the chapter. The bank and company records rarely agree. Why? Because of timing differences. Bank side, start with bank balance, adjust for deposits in transit, outstanding checks, plus or minus bank errors. Deposits in transit, company recorded deposit, bank has not yet, add to bank. Deposits in transit, company recorded the deposit, but the bank has not recorded the deposit, you add to bank. Outstanding checks, company wrote the check, bank has not cleared it, subtract from bank. Outstanding checks, the company wrote the check, the bank has not cleared the check, subtract from bank. That's on the bank side. On the book side, start with book balance. Adjust for collections by bank, interest earned, non-sufficient fund checks, service charges, minus or plus errors. Outstanding checks. One of the most tested concepts. Definition: a check written and recorded by the company but not yet cleared by the bank. Example: company writes check $1,000. The company records it. The bank has not processed it. This is an outstanding check. Adjustment: subtract from bank balance. Subtract from bank balance. This is on the book side. The company writes the check for $1,000. The company records the check in its book. The bank has not processed the check. This is an outstanding check. Adjustment: subtract from bank balance. Non-sufficient fund checks. NFS, non-sufficient funds. Customer's check bounced. A customer's check bounced. Bank removes money. Company must also remove money. Adjustment: subtract from books. Deposits in transit. The company deposited cash. Bank has not recorded it. Adjustment: add to bank balance. Bank service charges. Example: monthly fees, wire fees, check printing fees. Bank already deducted. Company has not. Adjustment: subtract from books. Okay. Interest earned. Bank may add interest. Bank knows. Company may not know yet. Adjustment: add to books. Compensating balance. A minimum balance required by a bank. Example: loan requires maintaining $50,000. Oh, okay. A minimum balance required by a bank. This is compensating balance. Compensating balance. This is a minimum balance required by a bank. Example: loan requires maintaining $50,000. Company cannot freely use it. Important point: may require disclosure or classification depending on restrictions. Petty cash. Small amount of cash used for office supplies, postage, small expenses. Example: petty cash fund $500. Normally, no adjustment unless replenished. Cash over in short. Cash over in short. Actual cash differs from expected cash. Example: expected $100, actual $95, short $5 expense. Internal controls over cash. Internal controls over cash. Far love this question. Okay. The goal: prevent theft. Key controls. Separation of duties. Different people should handle cash, record cash, reconcile cash. Never let one person do all three. Okay? Never let one person do all three. Different people should handle cash, record cash, reconcile cash. Never let one person do all three. Bank reconciliation, best control over cash, helps detect errors, fraud, missing deposits, unauthorized checks. Financial statement impact: balance sheet, cash plus cash equivalent shown together. Examples: cash $100,000, treasury bills $30,000, report cash and cash equivalent $130,000. Most tested for rules. Memorize these. Memorize them. Bank side, bank balance, plus deposits in transit, minus outstanding checks plus or minus bank errors. Okay, that's on the bank side. You start with bank balance, you add deposits in transit, you subtract outstanding checks plus or minus bank errors. It will depend. On the book side, you start with book balance plus interest earned, book balance plus interest earned plus collections by bank minus non-sufficient funds checks, minus NFS checks minus service charges plus or minus book errors. Cash equivalent rule. Original maturity, it has to be 3 months or less. Original maturity, 3 months or less. Outstanding check, recorded by company, not yet recorded by bank. Subtract from bank. Okay? Outstanding check, it's recorded by the company, not yet recorded by bank. You subtract from bank. Deposit in transit, recorded by company, not yet recorded by bank. Add to bank. This is deposit in transit. Recorded by company, not yet recorded by bank. Add to bank. What you must master before moving on. What you must master before moving on. Difference between cash and cash equivalents. 3-month maturity rule. Restricted cash. Deposits in transit. Outstanding checks. Non-sufficient funds checks. Bank service charges. Interest earned. Full bank reconciliation process. Internal controls over cash. If you can do bank reconciliations quickly and instantly identify whether an item affects the bank side or book side, you'll dominate about 80% of the questions in this chapter. Let's do it. Let's get it done, my friend. Yeah, let's do it. Okay. I need some music for this. So, we got the lesson. Let's go to questions. I'm gonna take 5 questions at a time, so we don't feel cash and cash equivalent. It's not too heavy. It's only 31 questions. But let me take 5 to see how we do. All right. The following information pertains to the company at December 31st, year 4. The company's cash balance per book is $10,000, and their cash balance per bank statement is $13,500. Reconciliation of the statement with the company books reveals the following information. Bank statement error in the company's favor is $1,525. Bank charge $25. Deposit received by bank directly from customer $500. Check drawn on the company's account payable to a vendor dated and recorded December 31st, year 4, but not mailed until January 11, year 5. $1,500. Okay. On the company's December 31st year 4 balance sheet, what is the net cash balance after reconciliation? Net cash balance after reconciliation. Here we have. All right, what do we do? What is the net cash balance after reconciliation on the company's 31st year 4 balance sheet? Balance sheet, not the bank statement. What is the cash balance after reconciliation? Okay. So what do we start with? The following information pertains to the company as of December 31st year 4. The company's cash balance per book is $10,000. So we have $10,000 book balance. All right. So we start with the $10,000 book balance. Bank statement error in the company's favor is $1,525. This is a bank error in the company's favor. Is it recorded in the book or only in the bank? I don't know yet. So bank book balance is $10,000. Bank charge, subtract bank charge, $25. Deposit received by bank directly from customers, that should also be recorded in the book. Deposit received. The bank knows, but the book does not know, so you add this to the book. So that's going to be $10,500. Check drawn on the company's account payable to vendor. Okay, the company writes the check payable to vendor, dated and recorded December 31st year 4. It is in the company's book, but not mailed till January 11 year 5. This is $1,500. The company has recorded that, but the bank has not recorded that. So what I'm doing now is match the bank statement with the book balance. Okay. All right, match the bank statement. The bank statement is $13,500. The book balance is $10,000. So we need to balance that. Okay. Bank statement error in the company's favor, $1,525. The error appears in the bank statement, which is $13,000. So I'm going to do what? Subtract from bank. It's a bank error. If it's a bank error, you subtract from bank. Outstanding check, cash equivalent, book side, bank side. Okay. So I'm not going to take a long time trying to do it myself since it is the first question. We don't want to use too much mental energy for this. Unable to previous operation. Why? No, wait. ¿Qué ha pasado? What's going on? What is going on, my friend? We can't do that. Oh. Well, we didn't have coffee today. Since like didn't have coffee, I don't drink coffee, but since like this thing didn't have coffee today. Gonna have to read. The following information pertains to the company at December 31st year 4. The company's cash balance per book is $10,000 and their cash balance per bank statement is $13,500. Reconciliation of the statement with this company books reveal the following information. Bank statement error in the company's favor, $1,525. Bank charge, $25. Deposit received by bank directly from customers, $500. Check drawn on the company's account payable to a vendor, dated and recorded December 31st year 4, but not mailed until January 11 year 5, $1,500. On the company's December 31st year 4 balance sheet, what is the net cash balance after reconciliation? Let's do this the far way. Step 1. Start with book balance. Book balance $10,000. Adjust the book balance. Bank charge minus $25. Bank already recorded it. Company has not. Deposit received directly from customer equals $500 plus $500. $500. Bank collected it. Company has not recorded it. Adjusted book balance 10,000 minus 25 plus 500. That's $10,475. Step 3. Analyze the other items. Bank statement error in company's favor, $1,525. The bank made an error that increased the bank balance. To correct the bank side, alright, so 13,500 minus 1,525, 11,975. Check recorded but not mailed. This is the trick. $1,500. Because the check was recorded on December 31st but not mailed till January 11, it was not actually outstanding. Oh. On an outstanding check must be written, delivered, or issued, not yet cleared by the bank. Since it was not mailed, it would not reduce cash at year end. Therefore, the company must add back $1,500 to its books. Adjusted book balance $10,000, $10,475 plus 1,500, that's 11,975. Final reconciliation cash balance 11,975. Okay. Bank error in company's favor, subtract from bank. Bank charge, subtract from books. Collection by bank, add to books. Check not mailed, add back to books. Not valid outstanding check. It's not a valid outstanding check. If the check was written but not mailed at the end of the year, it's not an outstanding check. Remember. So that's 11,975. Okay. Let's keep going. At October 31st of the current year, the company had cash accounts at 3 different banks. One account balance is aggregated solely for a November 15th payment into a bond sinking fund. A second account used for branch operations is overdrawn. The third account, used for regular corporate operations, has a positive balance. How should accounts be reported in Dingo's October 31st classified balance sheet? The segregated, all right, how should they report that? Wait, let me try. How should accounts be reported in the company's October 31st classified balance sheet? How should accounts be reported? There is one account. There is one account. One account balance is segregated solely for a November 15th payment into a bond sinking fund. The other account, used for branch operations, is overdrawn. The third account, used for regular corporate operations, has a positive balance. How should you report that? You have three different accounts. Segregated account should be reported as a non-current asset. Non-current asset. The regular account should be reported as a current asset. The overdraft should be reported as a current liability. It's a liability. The segregated and regular account should be reported as current assets, and the overdraft should be reported as a current liability. The segregated account should be reported as a non-current asset, and the regular account should be reported as a current asset, net of overdraft. Oh, you see? The segregated and regular accounts should be reported as current asset net of the overdraft. Okay, yeah. And this is a lot to read. Could just take a picture. Snap a picture. Wake up, wake up. We got work to do. We got work to do. Just wake up. Come on now. Oh, what? Previous operation due to low memory. Low memory. What? Okay. I'm gonna see what to do with this. Let's read. At October 31st of the current year, the company had cash accounts at three different banks. One account balance is segregated solely for a November 15 payment into a bond sinking fund. A second account, used for branch operations, is overdrawn. The third account, used for regular corporate operations, has a positive balance. How should accounts be reported in the company's October 31st classified balance sheet? The segregated account should be reported as a non-current asset. The regular account should be reported as a current asset, and the overdraft should be reported as a current liability. The segregated and regular accounts should be reported as a current asset, and the overdraft should be reported as a current liability. The segregated account should be reported as non-current asset, and the regular account should be reported as a current asset net of overdraft. The segregated and regular accounts should be reported as current assets net of overdraft. Which one? This question is testing restricted cash, and bank overdrafts. Step 1. The segregated account. The account is set aside solely for a bond sinking fund payment. A sinking fund is restricted cash. Since it is related to long-term debt, bonds, it is generally reported as a non-current asset. Segregated account, non-current asset. Step 2. The regular operating account. This is normal cash available for operations. Report as a current asset. Step 3. The overdrawn branch account. A bank overdrafts means the company has written more check than cash available in that account. Under US GAAP, if the overdraft is at a different bank, it is generally reported as a current liability rather than offset against positive cash balances. Okay, so overdraft equals current liability. The segregated account should be reported as a non-current asset. The regular account should be reported as a current asset, and the overdraft should be reported as a current liability. The memory rule: restricted for long-term debt, non-current asset. Restricted for long-term debt, non-current asset. Regular cash, current asset. Bank overdraft at another bank, current liability. That combination prints to okay. That's good. If the overdraft is at the same bank but a different account, it would be net of overdraft. There is a favorite for trick. If the overdraft and the positive cash accounts are at the same bank, you can offset them. Example, checking account A, $20,000, checking account B, overdraft $5,000, reported cash $20,000 minus $5,000, which is $15,000. Report net cash of $15,000. No current liability is reported. If the overdraft is at a different bank, example, Bank A $20,000, Bank B overdraft $5,000, you cannot offset. Report cash $20,000 current asset, bank overdraft $5,000 current liability. Same bank, net offset. Different bank, cash asset plus current liability separately. Excellent. What else should I ask? Okay. What else here? Overdraft, you have the regular account. All right, that makes sense. That's number 1. The segregated account should be reported as a non-current asset. The regular account should be reported as a current asset, and the overdraft should be reported as a current liability. Okay, and you already know why. It's because it's at a different bank. Good job. The company has a checking account at Neighbor Bank and an interest-bearing savings account at another bank. On December 31st, the bank reconciliation for the company are as follows. The first bank balance $45,000, deposit in transit $5,000, book balance $50,000. Neighbor bank balance $15,000, outstanding checks $15,500. Book balance $500. What amount should be classified as cash on the balance sheet, on the company's balance sheet at December 31st? What amount should be classified as cash? You have a balance. The bank balance is $45,000. Deposit in transit $5,000. Book balance is $50,000. Neighbor bank. Bank balance $15,000. Outstanding checks $15,500. Book balance is negative. Overdraft $500. One bank is overdraft $500. The other bank has a book balance of $50,000. Deposit in transit. If you have a deposit in transit, what do you do? Let me go back to this. Deposit in transit. Book side, interest earned, collection, non-sufficient book errors. Okay. Bank side, deposit in transit. Okay. Outstanding checks. What do you do with the deposit in transit? If you have a deposit in transit, what do you do? Deposit in transit. Cash that the company has already recorded and deposited, but the bank has not yet recorded it. Okay. What do you do? Add it to the bank balance during the bank reconciliation. Add it to the bank balance. Bank balance is $45,000. Okay. Deposit in transit $5,000. Book balance is $50,000. Now, when you add that to bank balance will be $50,000. Book balance will be $50,000. Imagine that. The bank balance is $45,000. The deposit in transit is $5,000. The book balance is $50,000. How do you reconcile this? Given bank balance $45,000, deposit in transit $5,000, book balance $50,000. Adjust the bank side. A deposit in transit is added to the bank because the bank has not recorded it yet. 45 plus 5, 50,000. Adjusted bank balance 50 equals $50,000. Step to compare the book side. Book side $50,000. Adjusted bank balance $50,000. They match. Okay, that's what you're looking for. It's the match. It's not money you're taking from your book to send. It's not a transfer. That's what I was thinking. I was thinking that you're transferring money from the book to the bank. No, that's not what you're doing. That money is already recorded in the book, but it's not yet recorded in the bank. So what you got to do is record that money. It's not that you're sending money to the bank from your book. Actually, the money is not even in the book. Right? The actual money. You have the number in the book, but not the actual money. So what you're doing is reconciling the book and the bank. So in the book, you have $50,000. In the bank, you have $45,000. Why? It's because there is a deposit in transit. The deposit in transit, it's a deposit that's already recorded. in the book, but not yet recorded in the bank. So now what you're going to do, you will add that $5,000 to the bank, and then that will match. So how much cash balance do you have? You have a $50,000 cash balance. Well, in this case, how much cash balance do you have? You have $50,000 of cash. Here's why. The company actually deposited $5,000 before year end. The books currently show $50,000. The bank is simply behind and has not recorded the deposit yet. So after reconciliation, a bank balance for the 5,000 plus 5,000 is 50,000. Think of it this way. If you deposited $5,000 at 4:55 p.m. on December 31st, the money is no longer in your pocket. It's already your cash in bank, even if the bank does not process it until January 2nd. Therefore, the amount reported on the balance sheet is $50,000. The reconciled cash balance, the amount of cash you truly have, is $50,000. Okay? So you have $50,000 here. The other one, you have a bank balance of $15,000. Outstanding check is $15,500. So in your book, you have negative $500. What amount should be classified as cash on the balance sheet? Cash is $50,000, and you have a liability of $500. Yeah. Because there are two different banks. Yes. There are two different banks. One is overdrawn. It has an overdraft on it. The other one has a cash balance. So how much cash do you have? You have $50,000 cash, but you also have a $500 liability. Excellent. Okay. The company had the following balances at the end of year one. At the end of year one, in the accounts, it has at its possible bank. Checking account 101, $175,000. Checking account 201, negative $10,000. Money market account $25,000. 90-day certificate of deposit due 2/28 year 2 is $50,000. 180-day certificate of deposit due March 15th year 2, $80,000. What's the question? On its year one balance sheet, what amount should the company report as cash and cash equivalents? Cash and cash equivalents, okay? It's the same bank. One account has $175,000. One account has a $10,000 overdraft on it. So you will subtract the $10,000. So it's gonna be $165,000 plus money market $25,000. 165 plus 25. 165 plus 25. What is it? 165 plus 25, that's 190. So $190,000. You also have a 90-day certificate of deposit due February 28, year 2. You can add this because this is cash equivalent. 90 days, 3 months or less. 50 plus 50,000. That's 240,000. Yes, $240,000. The 180 days is not cash equivalent. It is not cash equivalent. This is investment. 180 days, 240,000. Let's see. We're good. We're getting it, my friend. Man, we got it. That's good. That's good. Yeah, this chapter is a friend. Is friendly. At the end of year 1, a privately held company has 2 checking accounts, a money market account, and 3 U.S. Treasury bills. The U.S. Treasury bills were purchased on November 30th, year 1, November, December, okay? And have maturity date of January 15th, November, December, January. All right, less than 3 months. January 15, year 2. November 30th, year 2. And March 31st, year 3, respectively. Which of the following is a complete and accurate list of the cash and cash equivalent that the company should report at the end of year 1? Okay, so let's see. At the end of year 1, privately held company has 2 checking accounts, money in a money market account. That's 3 checking account, money market account, they are cash and cash equivalent, and 3 U.S. Treasury bills. One of these is cash equivalent. U.S. Treasury bills were purchased November. The U.S. Treasury bills were purchased on November 30th, year 1, and have maturity date of January 15th. This one is cash equivalent. Year 2, November. This is not cash equivalent. All right, only one of them is cash equivalent. So let's go. We have 2 checking accounts, 1 money market account, and 1 treasury bill. The 2 checking accounts and the money market account. No, the 2 checking accounts, the money market account, and the U.S. Treasury bill with the maturity date of January 15th and November. No. The 2 checking accounts, the money market account, and all the treasury bills. No. The 2 checking accounts, the money market account, and the U.S. Treasury bill with a maturity date of January 15th, year 2. That's correct. Let's go. Yes, sir. Yes, sir. This is good. I love this. I love this. I love this. We're done with the first 5 questions. Let's get, okay. I love this, man. This is good. Becomes a video game. If you love to play video game, this is the game you gotta play. This is nice. It's like just like playing a game. Let's go to the questions. Cash equivalent. We have 26. We can do this today. 26 more questions left. We can complete this chapter today. Let's get 10. Let's get 10 questions. All right. What time is it? What time is it? Okay, we still have 17 minutes left. Let's go. The company's monthly bank statement shows a balance of $22,300. Monthly bank statement shows a balance of $22,300. Reconciliation of the statement with company books reveals the following information. Reconciliation reveals that information. Bank service charge minus from the book $15. Insufficient funds check $700. Insufficient funds deduct from the book. Yes. Outstanding checks $2,250 is a check that you have written but that is not cleared yet. This you need to add to the bank, but you have already reported that on your book. Deposits in transit $500. You need to add to bank because this is money that you have deposited, but the bank has not received it yet, or the bank has not recorded it yet. Okay. The company deposited a check and the bank cleared it for $267. But the company improperly recorded it as $276. So, okay. So this you're going to subtract from the book. All right, 276 minus 267. The bank credited the company's account for $200 deposit that was not meant for another bank customer. That was meant for another bank customer. So that was an error, $200 error. The bank credited. So subtract from bank. The bank was credited to you, but you did not record it in your book. Subtract from bank. What is the net cash balance per books after the reconciliation? Okay. So you start with the book balance, $22,300. This is what you start with. Bank service charge minus $15. This is bank service charge. $22,300 minus 15. Minus 15. Insufficient funds check. This is a check that was deposited into the bank, but it's going to bounce. It's going to bounce, but you have recorded it in the book. Minus $700. You have to subtract this from the book. Subtract this from the book. Outstanding checks. This is check that you have written, but the bank has not cleared yet. So you don't need to do anything on your book, on your books. Deposits in transit. This is the money you deposited. It is in transit. The bank, this is on the bank side. Don't worry about that. If you're working on books, don't worry about what's going on with the bank. The bank will adjust. Now, there is something else. All right, something else happens. There is a check. Now you have $21,585. $21,585. Okay. There is a check that was cleared, and the check was for $267. But in the book, you recorded $276. So you will need to subtract 67 to 76. 67. That's $9. Yes, that's $9. I was counting with my finger. Hey, that's $9. All right, cool. What you talking about? It's $9. Okay, so minus $9. 21,576. Something else happened. The bank credited another $200 that was not meant for, well, if the bank credited that money, you did not put that money on your books. You didn't even know. Why should you put that money in your books? The bank credited that to you in the bank, so bank needs to adjust it. So your book balance should be 21,576. 21,576. No. What you talking about? What? Something is going on here. Something is going on. Let me see what's wrong. We're almost there. I know we're almost there. The company's monthly bank statement shows a balance of $22,300. Reconciliation of the statement with company books reveals the following information. Bank service charge $15. Insufficient funds check $700. Outstanding checks $2,250. Deposits in transit $500. The company deposited a check and the bank cleared it for $267, but the company improperly recorded it as $276. The bank credited the company's account for a $200 deposit that was meant for another bank customer. What is the net cash balance per books after the reconciliation? Okay, reconciliation format. Step 1, start with bank balance. Bank balance shows. We're talking about bank balance. So we're solving for bank balance, not book balance. Okay, start with bank balance, $22,300. Step 2, adjust the bank side. Deposit in transit plus $500. That's good. Subtract outstanding check. Yes. Outstanding checks. Check I have written that the bank has not. Why subtract? Subtract outstanding checks. Subtract bank error. Adjust bank balance. $20,350. Adjust the book side. Why do you subtract the outstanding check? On the bank side. Oh yes. Wow. I was thinking about adding the outstanding check, but it's subtract because that money left my books. It also need to leave the bank. It's not that I'm subtracting from the book to add to the bank. Gotta think about that. Okay, subtract. Adjust bank balance. Adjust the book side. Start with unknown book balance is X. Bank service charge minus 15. Non-sufficient check 700 minus 700. Company recorded error. Actual check deposited 267. Recorded 276. Books are overstated by $9 minus $9. Adjust book balance. Book balance X minus 15 minus 700 minus 9. X minus 724. Step 4, set equal to adjusted bank balance. X minus 24 minus 724 equals 20,350. X equals 21,074. 21,074. Okay. 21,074. Okay. The bank is 20,000. 21,074. Answer. The cash balance per books before adjustment is 21,074. The question asks for the net cash balance per books after reconciliation, which is the reconciled balance. 21,074 minus 724 is 20,350, which is the same amount that you have in the bank, and which is correct. Net cash balance after reconciliation. The reconciled cash balance must be 20,350. What did I have wrong here? The company's monthly bank statement. This is not book. Bank statement. $22,300. You have bank service charge. Bank service charge is on the book side. Insufficient funds, check. Insufficient funds, check. That's also in the book. The check. But this check, you need to subtract it from the bank too. You need to subtract this check from the bank. Insufficient funds, check. No. All right, the bank already knows it's insufficient. The bank has already reported that. That's good. Okay. It's insufficient funds. The bank knows. Outstanding checks. This is what the bank didn't know. Outstanding check. That money left your books. It also need to leave the bank. So 22,300 minus 2,250. 22,300 minus 2,250. 20,050. Deposits in transit. That's the money that you deposited that the bank has not received yet. You need to add that to the bank. Plus 500. 20,550. Okay. There is a $9 here. The bank cleared the check for $267. All right, that was cleared. That was cleared for $260. It was cleared for $260. But the company, that's on the book side. You need to make this adjustment on the book side. The bank credited the company for $200 that was meant for another bank. So this, the bank, you need to subtract this. Subtract this. Subtract minus 200. 20,350. That's on the bank side. I would say this should also be on the book side. Let me see something, because by adjusting the bank side, I need the book side. Would if the bank side is well adjusted, shouldn't this also be the book side? Do I still need to go ahead and reconcile the book side? This is a waste of time, I think. If I already have the answer. Exactly. This is the shortcut CPA candidate eventually learn. If the question asks, what is the reconcile cash balance? And you can fully adjust the bank side, then you're done. Amen. That's right. Come on now. You're going to waste my time like that. We can't do that. Okay? What is the Okay, so... and you can fully adjust the bank side, you're done. In your problem, bank balance, deposit in transit $500. Well, bank balance $22,300. Deposit in transit $500. Outstanding checks $2,250. Bank error $200. Reconcile balance is $20,350. Once you've reached $20,350, that is the true cash balance. You do not need to adjust the book side unless the question asks for the adjusted book balance. The question asks for the book balance before adjustment. You need to solve for a missing book balance. Okay. Unless the question asks for the adjusted book balance. What did they ask? What is the net cash balance per books after the reconciliation? After you reconcile? Time for break. It's time for break. Okay, everybody. We're going to go to break and then we'll come back. We'll come back in 10 minutes.
Current ratio, current assets over current liabilities. Quick ratio, cash plus marketable securities plus accounts receivable. Over current liabilities. Quick ratio, cash plus marketable securities. Days sales outstanding, average accounts receivable. Over net credit sales times 365. Days sales outstanding, average accounts receivable. Over net credit sales times 365. Days sales outstanding, average accounts receivable. Over net credit sales times 365. Days sales outstanding, ending accounts receivable. Over net credit sales times 365. Days sales outstanding, ending accounts receivable. Over net credit sales times 365. Days sales outstanding 365 over accounts receivable turnover. Days sales outstanding 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding, ending inventory over cost of goods sold times 365. Days inventory outstanding 365 over inventory turnover. Days inventory outstanding 365 over inventory turnover. Days inventory outstanding 365 over inventory turnover. Times EBIT over interest expense times interest earned. EBIT over interest expense times interest earned. EBIT over interest expense. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Income over average total assets. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt to equity ratio. Total liabilities over stockholders' equity. Debt to equity ratio. Total liabilities over stockholders' equity. Current ratio. Current assets over current liability. Current ratio. Current assets over current liabilities. Current ratio. Current assets over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Quick ratio. Cash plus marketable securities plus accounts receivable over current liabilities. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Net profit margin. Net income over sales. Day sales outstanding. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Average accounts receivable over net credit sales times 365. Day sales outstanding. Ending accounts receivable over net credit sales times 365. Day sales outstanding. Ending accounts receivable over net credit sales times 365. Day sales outstanding. 365 over accounts receivable turnover. Day sales outstanding. 365 over accounts receivable turnover. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Average inventory over cost of goods sold times 365. Days inventory outstanding. Ending inventory over cost of goods sold times 365. Days Days inventory outstanding. Ending inventory. Over cost of goods sold time. 365. Days inventory outstanding. Ending inventory. Over cost of goods sold times. 365. Days inventory outstanding. 365 over inventory. Turnover. Days inventory outstanding. 365 over inventory. Turnover. Days inventory outstanding. 365 over inventory. Turnover. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Accounts receivable. Turnover. Net credit sales over average accounts receivable. Accounts receivable. Turnover. Net credit sales over average accounts receivable. Accounts receivable. Turnover. Net credit sales over average accounts receivable. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income.
Back to work. Back to work. My friend, we're back. This is a nice chapter. Let's take advantage and complete this as quick as possible. Okay. All right, the company's monthly bank statement shows a balance of $22,300. Reconciliation of the statement with the company books reveals the following information. Bank service charge. Remember, we're talking about the bank statement. All right, here we're talking about the bank statement. Bank service charge $15. Bank service charge $15. This should be adjusted on the book side. Insufficient funds check. This should be adjusted on the book side. Outstanding checks. Outstanding check. This needs to be adjusted on the bank side. Minus outstanding check. This is a check that I have written, but the bank has not removed that money from the account yet. So in this case, I need to subtract that amount from the bank. Subtract that amount from the bank. Deposits in transit. Deposit in transit is a deposit that I made, but that is not reflected on my account yet. $500. So I need to add this. Okay. So you add to the bank. The company deposited a check and the bank cleared the check. The bank cleared the check for $267. Okay, the bank cleared the check for $267, but the impproperly improperly recorded it as $276. This is on the book side. This is not on the bank statement side. The bank is already cleared. It's okay. The bank credited the company's account for $200 deposit that was meant for somebody else. Now the bank needs to adjust that, because you're not supposed to put money in my account that is not mine. The book does not know that yet, but the bank knows that money has been credited. So you need to subtract this from the bank, and then the result, you will have it. Makes sense? All right, excellent. This is a story. If you can tell the story, you don't need to memorize any formula here. So what's 20,350. 20,350. Okay. Let's keep going. The company's cash balance in its balance sheet is $1,300,000, of which $300,000 is identified as a compensating balance. Ooh, compensating balance. Additionally, alright, let me read that because I haven't seen the compensating balance. The company's cash balance in its balance sheet is $1.3 million, of which $300,000 is identified as a compensating balance. Compensating balance. Additionally, the company has classified cash of $250,000 that has been restricted for future expansion or future expansion plans as other assets. Which of the following should the company disclose? Should the company disclose in the notes to its financial statements? Compensating balance, restricted balance. Which one should be disclosed? Okay. This question is testing the difference between compensating balances and restricted cash. Compensating balance. A compensating balance is a minimum. Oh, yes. Okay. A compensating balance is a minimum amount the company must keep on deposit with a bank, often as part of a borrowing arrangement. Even though it's included in cash, users of the financial statements need to know that that part of the cash is not freely available. Compensating balance should be disclosed. Yes. Restricted cash for future expansion. The company has already classified the $250,000 as other assets because it is restricted for future expansion. Since it is separately classified on the balance sheet, the nature of the restriction should also be explained. Restricted cash should be disclosed. The rule for the exam. Whenever cash is restricted or subject to a compensating balance arrangement, the company generally discloses the nature and amount of the restriction. Okay, so both the compensating and the restricted cash balance should be disclosed in the notes to the financial statements. Memory trick. Compensating balance, disclose. Restricted cash, disclose. If cash is not fully available for general use, users need to know why. Okay. Okay, mon ami. Good job. The company has a checking account at its possible bank and an interest-bearing savings account at home bank. On December 31st, the bank reconciliation for its possible are as follows. Now for the company are as follows. Bank balance, $27,000. See, we're starting with the bank balance. Bank statement, but not book balance, okay? Bank balance, $27,000. Deposit in transit, $3,500. Book balance, $30,500. This is at its possible bank. At the other bank, we call home bank. Bank balance, $10,000. Outstanding checks, $13,000. Book balance, negative $3,000. What's the question? The question says, what amount should be classified as cash on the company's balance sheet at December 31st? Okay. Cash will, if it's different bank, all right, different bank, what is your cash balance? Your cash balance is $30,500. That's what it is. Because the bank balance is $27,000. Deposit in transit, $3,500. You're going to need to add this to the bank. That's going to make it $30,500. And it matches, it balances. That's good. $30,500. You don't need to worry about this $3,000 negative that you have at the other bank. It is considered as a liability. But yeah, it's not an adjustment to the other bank. Excellent. We're good. This is good. The following information pertains to Graco at December 31st, year 3. Book balance, $12,000. Bank statement balance, $16,000. Check drawn on the company's account payable to a vendor, dated and recorded December 31st, year 3, but not mailed until January 10th, year 4, is $1,800. This is not outstanding check. This is not an outstanding check. You just need to add this back to your account, whatever, to your book. On the company's December 31st, year 3 balance sheet, what amount should be reported as cash? It's cash. You have a book balance of $12,000. $12,000 bank statement balance, $16,000. Okay, so book balance $12,000. This is cash, but there was a check. The check was written, but you didn't mail the check until after over a year. This check is nothing. You got to add it back. So $12,000 plus $1,800, that's $13,800. That's it. $13,800 need to be reported as cash. This is your money. That's correct, my friend. Oof, this is good. The company has a checking account at small bank and an interest-bearing savings account at big bank. On December 31st, year 1, the bank reconciliations for the company are as follows. It has two accounts, one at small bank, the other one at big bank. The big bank balance, that's the bank statement, okay? $150,000. Deposit in transit, $500. This is a deposit that I make that is not reflected in the bank yet. So we need to add this to the bank balance. That will make it $155,000. Book balance, $155,000. It matches. Now let's go to small bank. Small bank, bank balance $1,500. Outstanding checks $8,500. Book balance negative $700. What's the question? What amount should be classified as cash on the company's balance sheet as of December 31st, year 1? Same question. What is your cash? Your cash is $155 because it's two different banks. Even though you have a negative balance at the other bank, you cannot adjust this on the other banks cash balance. All right. So this is going to be a liability, $7,000 liability you have with the other bank, but cash balance is 155,000. That's correct. Okay. On December 31st, the company had a cash balance on its books. We're talking about book now, not bank statement. On its books, $44,200, including $10,300 deposits sent to, but not yet received by the bank. This is on the bank side. This $10,000 is already reported inside of the $44,200. Yes. The company did not have any outstanding checks as of October 31st. The company's November bank statement noted $58,400 of deposits. $58,400 of deposit in November. And $49,700 of disbursements. Outstanding checks on November 30th totaled $7,000. Outstanding checks. There were no deposits in transit. You don't need to say that on November 30th. What is the company's cash balance on its books on November 30th? Should we only focus on November 30th, or does what happened in October is going to affect it? The company's November bank statement noted $58,400 bank statement November of deposits and $49,700 of the $700 disbursement. Okay, November. We have 58,000. This is bank statement. Now we're talking about books. If you can fully, all right. So let's see that. Let me do it like this instead, so that we don't waste time. If it's taking me time to think about it, there is something that I need to know. On October 31st, the company had a cash balance on its books of $44,200, including $10,300 deposits sent to but not yet received by the bank. The company did not have any outstanding checks as of October 31st. The company's November bank statement noted $58,400 of deposits and $49,700 of disbursements. Outstanding checks on November 30th totaled $7,000. There were no deposits in transit on November 30th. What is the company's cash balance on its books on November 30th? This is one of those FAR questions where you need to determine November book activity from the bank activity. All right, only focus on November. Start with October 31st. Book balance, $44,200. Figure out November book deposits. The bank recorded deposits during November of $38,400. No, $58,400. But that includes the October deposits in transit of $10,300. Those $10,300 were already on the books in October. So November book deposits are $58,000 minus $10,000 Okay. That should be $48,100. Step 3, figure out November book disbursement. Bank disbursement during November. All right, let me redo that because it has an error. The November bank statement, instead of 38,400, it is 58,400. Okay, so we start with October 31st book cash, $44,200. Step 2, calculate November book deposit. Bank deposits in November is $58,400. Bank statement deposits, okay. Subtract beginning deposit in transit already recorded in October books. 58,400 minus 10,300, 48,100. Book deposits for November, 48,100. Step 3, calculate November book disbursements. Bank disbursements, 49,700. Add ending outstanding checks. Ending outstanding checks. $49,700 plus $7,000, $56,700. Book disbursements, $56,700. Step 4, calculate ending book cash. 44,200 plus 48,100 minus 56,700. This is 35,600. Answer is $35,600. I need to come back to this to understand it. 35,600. I need to. Seems like I'm feeling hungry. Yeah. Let me finish with this few questions. I just started this session. Okay. No. Feeling really hungry. Let me get something to eat. Be right back.
Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, average accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net credit sales times 365. Day sales outstanding, ending accounts receivable, over net credit sales times 365. Day sales outstanding, 365 over accounts receivable turnover. Day sales outstanding, 365 over accounts receivable turnover. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, average inventory over cost of goods sold times 365. Days inventory outstanding, over cost of goods sold times 365 days inventory outstanding. Ending inventory over cost of goods sold times 365 days inventory outstanding. Ending inventory over cost of goods sold times 365 days inventory outstanding. Ending inventory over cost of goods sold times 365 days inventory outstanding. 365 over inventory turnover. Days inventory outstanding. 365 over inventory turnover. Days inventory outstanding. 365 over inventory turnover. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Times interest earned. EBIT over interest expense. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Accounts receivable turnover. Net credit sales over average accounts receivable. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Inventory turnover. Cost of goods sold over average inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Cost of goods sold. Beginning inventory plus purchases minus ending inventory. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Gross profit. Sales minus cost of goods sold. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Net income over average total assets. Return on assets. Income over average total assets. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Return on equity. Net income over average stockholders' equity. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt ratio. Total liabilities over total assets. Debt to equity ratio. Total liabilities over stockholders' equity. Debt to equity ratio. Total liabilities over stockholders' equity. Current ratio. Current assets over current liability. Current ratio. Current assets over current liabilities. Current ratio. Current assets over.
All right, so I was so hungry, man. Wow. It's not a type of study when you just sit down and you're reading in your mind. By just speaking and repeating the lesson, it makes you more hungry. Okay. All right, let me understand this. Still eating. Including, let's go. On October 31st, the company had a cash balance. October 31st, the company had a cash balance on its books of $44,200, including $10,300 deposits sent to but not yet received by the bank. Not yet received by the bank. Okay. The company did not have any outstanding checks as of October 31st. The company's November bank statement noted $58,400 of deposits and $49,700 of disbursements. Outstanding checks on November 30th totaled $7,000. There were no deposits in transit on November 30th. What was the company's cash balance on its books on November 30th? Okay. So here's what we need to understand. Bank reconciliation. On the book side, cash balance per books plus interest paid by bank plus deposits not yet recorded in books minus bank charges minus returned check. Example, insufficient funds minus withdrawals not yet recorded in books, plus or minus recording errors. That will give you the net cash balance. On the bank side, bank statement balance plus deposits in transit. A deposit in transit, you need to add this to the bank, minus checks outstanding. Check outstanding is a check that I have written that has left my books but has not left the bank yet. So you need to subtract this from the bank. Check outstanding plus or minus bank errors. This will give you the net cash balance. Okay. All right. In this scenario, the company must adjust its $44,200 book balance for November deposits, $58,400 per its November bank statement, minus $10,300 October deposits in transit already recorded on the books. November disbursements, $49,700, and November outstanding checks, $7,000. In this scenario, the cash balance per books on November 30th is $35,600. Cash per books November 1st, $44,200. This is what you started with. Plus November deposits per bank, $58,400. Less October deposits in transit, $10,300. Deposit in transit, less. Including $10,300 deposits sent to but not yet received by the bank. October deposits in transit that has already been recorded in October. So now we're talking about November. That's why you will subtract this from November's balance, okay? Less November disbursements per bank, $49,700. Less November outstanding checks. Outstanding checks is a check that I have written, so it's been subtracted. That's where you have the $35,600. Excellent. The company's checkbook balance on December 31st, year 2 was $5,000. In addition, The company held the following items and is safe on that date. Check payable to the company dated January 2nd, year 3, in payment of a sale made in December, year 2, not included in December 31st checkbook balance, $2,000. Check payable to the company deposited December 15th and included in December 31st checkbook balance but returned by bank on December 30th. Stamped non-sufficient fund. The check was redeposited on January 2nd, year 3 and cleared on January 9th, $500. Check drawn on the company's account payable to a vendor, dated and recorded in the company's books on December 31st, but not mailed until January 10th, year 3. $300. The proper amount to be shown as cash on the company's balance sheet at December year 2 is. So how much cash balance does the company has at December year 2? What did we start with? The company's checkbook balance. Checkbook balance, December 31st, year 2 was $5,000. This is what we start with, $5,000. Then, let's go for the adjustments. Check payable to the company, dated January 2nd, year 3. But here we're talking about December 31st, year 2. Dated January 2nd, year 3. In payment of a sale made in December, year 2. Not included in December 31st checkbook balance. $2,000. So you made the sale December year 2. You received the payment. Check payable. Dated. The date of the check is January 2nd of year 3. Should you report that as a payment in December? Check payable to the company deposited December 15th and included in December 31st checkbook. But book balance, but returned by bank on December 30th for non-sufficient funds. The check was redeposited on January 2nd, year 3 and cleared on January 9th. That's $500. This is not part of December. This is part of January. Check drawn on the company's account payable to a vendor, dated and recorded in the books on December 31st, but not mailed until January 10th. So you have not mailed the check. It's not outstanding. It's not outstanding. What you're gonna do? Add back the $300. So $5,300. What do you do with the $500? Check. Check payable. Deposited. You deposited the check, including December 31st. So you have included the $500. Subtract $500 then. Subtract $500. All right, let's do that. Let's see. If it's not correct, that's fine, but I will not find help for this. We start with $5,000. Okay. $5,000. Add back 300. Subtract 500. $2,000. What do we do with this $2,000? Check payable to the company dated January 2nd, year 3, in payment of a sale made in December. The sale was made in December, but the payment was sent in January. I'm going to subtract that too. Minus 2,000. It's going to be $2,800. Nope. Nope. So there is some rule we need to apply here. It looks like if the sale was made on a certain date, all right, this 2,000 has already been, let me see something. $4,800. So if we're not subtracting the 2,000, we subtract the we add the 300, subtract the 500, so it would be $4,800. There is one answer like that, but let's see. Let me find some help for this. I say, okay, good. $4,800. That's what I found. But I need to know the rules. They are more important. The company's checkbook balance on December 31st, year 2 was $5,000. In addition, the company held the following items in its safe on that date. Check payable to the company dated January 2nd, year 3, in payment of a sale made in December, year 2, not included in December 31st. Oh, not included in December 31st checkbook balance. Or it was not included. That's fine. Why would you subtract it if it was not included? Okay. Check payable to the company deposited December 15th and included in December 31st checkbook or checkbook balance, but returned by the bank for non-sufficient fund. Returned by the bank on December 30th. The check was redeposited on January 2nd, year 3, and cleared on January 9th. That's $500. Check drawn on the company's account payable to a vendor. Wait. Need to re-record that. The company's checkbook balance on December 31st, year 2 was $5,000. In addition, the company held the following items in its safe on that date. Check payable to the company dated January 2nd, year 3, in payment of a sale made in December, year 2, not included in December 31st checkbook balance, $2,000. Check payable to the company deposited December 15th and included in December 31st checkbook. Checkbook balance, but returned by the bank on December 30th, stamped non-sufficient fund. The check was redeposited on January 2nd, year 3, and cleared on January 9th. That's $500. Check drawn on the company's account payable to a vendor, dated and recorded in the company's books on December 31st, but not mailed until January 10th, year 3. The proper amount to be shown as cash on the company's balance sheet at December year 2 is, it should be $4,800. $4,800, that's what it should be. Because this $2,000 was not recorded. And should we record it? No, we should not, because it's not part of December. It's not even part of this quarter. Yes. All right, let's read that. Start with checkbook balance. Item 1. Check received, $2,000. The check is dated January 2nd, year 3. A post-dated check is not cash at December 31st. Very good. Since it was not included in the $5,000 balance, do nothing. Good. Adjustment 0. Item 2, non-sufficient fund check, $500. The company check bounced on December 30th. That means the company does not have the cash. The $500 was included in the $5,000 checkbook balance, so remove it. Yes. Item 3, check written but not mailed. It's not outstanding. Add it back. Very good. So in this case, if this sale was made at a certain date, let's say the sale was made in December, but the payment is received in January. Should we include that in payment for December? So this is normal. This is correct. Yes, for $4,800. This is where you have to separate revenue recognition from cash. For revenue, if this sale was made in December and the company earned the revenue in December, record the revenue in December. Example, accounts receivable $2,000, sales revenue $2,000. The sale belongs in December. For cash, the check is dated January 2nd. A post-dated check cannot be cashed on December 31st. That's right. Therefore, it is not cash on December 31st. Do not include it in cash. Instead, it remains an account receivable until the date of the check. That makes sense. Excellent. Yeah, makes sense. Makes sense. The following bank reconciliation is presented for the Kingston Company for the month of November, year 1. Month of November, year 1. Balance per bank statement. Balance per bank statement, November 30th, year 1. $18,040. Add deposit in transit, $4,150. Less outstanding checks, $6,300. Bank credit recorded in error, $20. Makes it $6,320. Balance per books, November 30th, year 1, $15,870. Data for the month of December, year 1 per bank follows. December deposits, $26,100. December disbursements, $22,420. Balance December 31st, year 1, $21,720. All items that were outstanding as of November 30th cleared through the bank in December, including the bank credit. In addition, $2,500 in checks were outstanding as of December 31st, year one. What is the balance of cash per books at December 31st, year one? How did we finish November? We finished November with a balance of $15,870. So this balance in November is coming through December. Okay. So in December we have deposits of $26,000. So I'm gonna say 15,000 because that's 15,000 at the end of November is a 15,000 at the beginning of December. 15,870. December deposits $26,100 plus $26,100. December disbursements 22 minus 22,420 minus $22,420. We have $19,550. Okay, $19,550. We have other transactions here. All items that were outstanding as of November 30th cleared through the bank in December, including the bank credit. What do you mean the bank credit cleared? In addition, $2,500 in checks were outstanding. So if there is a $2,500 check outstanding, okay, this check has been reported in the books but not yet in the bank. What is the balance of cash? Okay, balance of cash. What? $19,550. Balance December 31st, year one, 21,000. What do you mean the credit was cleared? Okay, let me find some help. The following bank reconciliation is presented for the company for the month of November, year one. Balance per bank statement, November 30th, year one, $18,040. Add deposit in transit, $4,150. Less outstanding checks, $6,300. Bank credit recorded in error, $20. That makes it $6,320. Balance per books, November 30th, year one, is $15,870. Data for the month of December, year one, per bank is December deposits, $26,100. December disbursements, $22,420, $420. Balance December 31st, year one, $21,720. All items that were outstanding as of November 30th cleared through the bank in December, including the bank credit. In addition, $2,500 in checks were outstanding as of December 31st, year one. What is the balance of cash per books at December 31st, year one? Okay. All right, all right. December 31st, year one. Let's see. All right, so let's get started. This is a classic for bank reconciliation. Roll forward problem. Roll forward. Find the November reconcile balance. From the bank reconciliation, bank balance November 30th is $18,040. Deposit in transit $4,150. Deposit in transit. Yeah, deposit in transit $4,150. Outstanding checks $6,300. Bank credit error $20. Reconcile balance is $15,870. Okay, makes sense so far. So November 30th balance $15,870. Step 2, determine December book deposits. Bank deposits during December is $26,100. Beginning. All right, let me see what you're trying to say. December. Okay. Beginning DIT November 30th, $4,150. All November outstanding items cleared in December. Since no ending DIT is mentioned, assumed ending DIT is 0. Book deposits $26,100 minus $4,150 equals $21,950. Step 3, determine December book disbursement. Bank disbursement during December is $22,420. Beginning outstanding checks $6,300. Ending outstanding checks $2,500. Formula for disbursements. Bank disbursements okay, let me see. 19,200. Compute December 31st book cash. 15,000 plus 21,000 minus 18,000. 15,870 plus 21,950 minus 18,620. That's 19,200. The 5-second method. For these problems, book deposits. Bank deposits beginning DIT, ending DIT deposit. And deposit in transit. DIT deposit in transit. That's what it should be. Beginning deposit in transit, ending deposit. Let me see. What does that stand? What does DIT stand for? Deposit in transit. Okay, I got it. All right. Bank deposits. Beginning deposit in transit. ending deposit in transit. No, okay, bank deposits minus beginning deposit in transit plus ending deposit in transit. Book disbursements, bank disbursements plus ending OC. What does OC stand for? What does OC stand for? Outstanding check. Okay. Outstanding check. That's it. Okay. Deposit. I'm gonna do this wrong so I can come back to it. What time is it? Okay, 37. All right. All right, let's move forward. All right, no, let me finish with this so I can move to the next question. I'm going to read this. November 30th bank balance is $15,870. Step to determine December book deposits. Bank deposits during December is $26,100. Beginning deposit in transit, November 30th, $4,150. All November outstanding items cleared in December. Since no ending deposit in transit is mentioned, assume ending deposit in transit is 0. Book deposits $26,100 minus $4,150. That's $21,950. Determine December book disbursement. Bank disbursements during December equals $22,420. Beginning outstanding checks, $6,300. Ending outstanding checks, $2,500. The formula. All right, book disbursement, bank disbursement. I can't see the whole thing. Sorry. So we have $22,420. $22,420 December disbursements plus $2,500. Where do we've got the $2,500? $2,500, which is the outstanding checks. 2,500 minus 6,300. 6,300. This is outstanding checks. Okay, minus outstanding checks. That's 18,620. Step 4, compute December 31st book cash. $15,870 plus $21,950 minus $18,620 equals $19,200. Okay. The 5-second method. For these problems, book deposits, bank deposits equal, you start with bank deposits minus beginning deposit in transit plus ending deposit in transit. Book disbursements, bank disbursements plus ending outstanding checks minus beginning outstanding checks. Bank disbursements plus bank disbursements plus ending outstanding checks minus beginning outstanding checks. Then beginning book cash. Beginning book cash plus book deposits minus book disbursements equals ending book cash. Okay. I haven't understood that the way I'm supposed to, but I'm gonna let it go so I can come back to it when my brain I feel more brain power to go through it. So even though I have the answer now, I'm going to make the answer incorrect so that it can bring it back to me. All right. The company had the following balances on December 31st, year 4. Cash in checking account. Cash in checking account, $350,000. Cash in money market account, $250,000. Restricted cash for use on a current liability, $100,000. U.S. Treasury bill purchased December 1st, year 4. Maturing February 28th, year 5. $800,000. This is cash equivalent. U.S. Treasury bond purchased March 1st, year 4. Maturing February 28th, year 5. This is not cash equivalent. Even if we are in December, this was purchased months. It will not mature in 90 days or less. What amount should Cook or should the company report as cash and cash equivalent in December 31st, year 4 balance sheet? Cash in checking account, $350,000. Cash in money market, $250,000. $350,000. That's $600,000, right? Yeah, $600,000. I'm being good at math. That's the one thing I really didn't like. But let's go. 350 plus 250, 600,000. Okay. We have restricted cash for use on a current liability. Restricted cash for use on the current liabilities. That means money you will be paying out to other people. Is it cash right now? Yes, restricted cash is cash. Restricted cash is cash. Plus $100,000. $700,000. U.S. Treasury bill purchased December 1st, year 4. Maturing February 28th, year 5. $800,000. Plus $800,000. $1,500,000. Okay. This U.S. Treasury bond, even though the maturity date is February 28th, year 5, it was purchased in March. So it's more than 3 months. $500,000, we are not going to include this in cash equivalent. So cash equivalent should be $1.5 million. That's what I would say. 1.5. 1 million. I have 1,400,000. So this restricted cash is not cash. Let me see. I'm going to take the 1.4. 1.4 is correct. So restricted cash. Let me see what they say about the restricted cash. In this case, the total cash and cash equivalent is 1,400,000. 350,000 plus 250,000 plus 800,000. when no restriction apply. Cash in checking accounts, here 350,000 is included in cash. The 250,000 money market account and $800,000, yes, of the treasury bill are cash equivalent. I understand. Money market accounts are included because they maintain a $1 per share value and are really convertible to cash. There is no maturity date. The treasury bill is included because it has an original maturity of 3 months or less from the purchase date. Okay? The $100,000 restricted cash would be presented separately from other cash and cash equivalents on the balance sheet. Since the March 1st year for treasury bonds maturity is longer than no, wait, I need more information about that $100,000. The $100,000 restricted cash would be presented separately from other cash and cash equivalent on the balance sheet. Why is that? Because it's a restricted cash is cash. Why would it be separate? Okay, so I have cash in checking account $350,000 as of December 31st, year 4. Cash in money market account $250,000. Restricted cash for use on a current liability is $100,000. U.S. Treasury bill purchased December 1st, year 4, maturing February 28th, year 5, $800,000. My question is about the $100,000 restricted cash for use on a current liability. Would that be considered as cash or cash equivalent? Oh, why not? Oh. Yes. You can do it. This is very common for a question. The key is that restricted cash is still cash. The question is whether it is current or non-current. Your items, checking account $350,000, money market $250,000, restricted cash $100,000, treasury bill $800,000 to $50,000. The restricted cash. The restriction is for use on a current liability. Since the liability is current, the restriction will be used within the next year. Therefore, it is reported as current cash. It is still cash. It is not a cash equivalent. Why isn't it a cash equivalent? I know it's not a cash. It's a cash. I understand. A cash equivalent is an investment that meets the 3-month rule. Example, treasury bill, commercial paper, money market funds. Restricted cash is not an investment. It is simply cash with a restriction. The treasury bill purchased December, matures February 28, year 5. Original maturity date equals 3 months is cash equivalent. What will be included in cash and cash equivalent? Checking account, money market. You would miss this. You would miss this too. The restricted cash is not included. I want to know why. Okay. The restricted cash is not included in cash in this question. The answer is 1.4. 1,400,000. So why would the $100,000 not included in cash? Because it says that the $100,000 restricted cash would be presented separately from other cash and cash equivalent on the balance sheet. Why is that? Excellent question. This area where 4 questions can differ depending on what exactly they are asking for. Let's look at your numbers. Checking account, money market, restricted cash, treasury bill. If the question asks how much cash and cash equivalent, many textbooks, what was the question? What amount should Cook report as cash and cash equivalent? Yes. Many textbooks and CPA questions will exclude restricted cash from the cash and cash equivalents line items because it is presented separately on the balance sheet. So they calculate, yes, I understand this part. So they make it 1.4. Why exclude the $100,000? Because the cash is not available for general use. The balance sheet might show current asset, cash and cash equivalent, $1,400,000. Restricted cash is shown separately as $100,000. The restricted cash is still cash, but it is presented separately so users can see that it cannot be freely spent. The CPA exam rule. There are 2 different questions. Question 1, is it cash? Restricted cash, yes, it is cash. Question 2, is it included in the cash and cash equivalent line item? Often, no. I said, what amount should the company report as cash and cash equivalent in its December 31st year 4 balance sheet? And it doesn't say in the line, it says in the balance sheet. Often no, because it is reported separately. Restricted cash is still cash, but it is cash with a label on it. The CPA exam may include it when asking about total cash resources. Exclude it when asking about the cash and cash equivalent account shown on the balance sheet. Okay, you gotta be mindful of that. Oh, yes. Yes. And the pillow. Okay. Let's keep going. We are almost done with this set. Almost done with this set of 10 questions. Number 10. On December 31st, the company's bank statement balance was $9,850. $9,850 and included a $150 charge for annual business account fees. The company also had the following items: deposits in transit, $5,000. This is the money that I have deposited, recorded in my books, but the bank has not seen it yet. Outstanding checks, $1,000. This is a check that I have written, that I have reported in my books, but that is not yet reflected in the bank statement. Non-sufficient funds checks received from customers, $750. The bank has seen that. I thought I had money, but the bank says no, the bank has removed that money. So I need to adjust this on my books. What amount should the company report as a cash on its December 31st balance sheet? Okay. We want to know how much should you report on your books. On December 31st, the company's bank statement balance was $9,850 and included a $150 charge for annual business accounts fees. The fee is already accounted for in the books, so you don't need to do anything with it. Okay. Now, deposits in transit. If you have a deposit in transit, this is also already in a book. The deposit in transit is already in a book. The bank has not seen it yet, but it's in a book. Outstanding checks. This is also already in a book. The bank has not seen it, but it's already in a book because I deposited the check. The bank has not seen it yet. Non-sufficient funds check received from customers. Now there is a problem. A customer said, I'm going to make a payment. And I say, okay. And the customer said the payment was made. I recorded that in my books. But the bank says that the money didn't come. So what I have to do, I need to subtract this from the book. Now I need to subtract $750 from $9,850. $9,850 minus $750. So that will be $9,100. Let's see. No. Oh, what's the problem here? What is the problem? Included a $150 charge for annual business account fees. Let me do that. Minus 150. 8,950. $8,950. Not even that. Not even that. Wait. $9,850. This is what the bank. This is bank statement. This is bank statement, my friend. This is bank statement. I really need to pay attention to when they talk about bank statement and books. This number I have here, the $9,800, is bank statement. This is what's showing in the bank. They tell me what's showing in the bank. They want me to find what's going on in my books. I can adjust the bank. If I adjust the bank, I don't need to adjust the books. Let's see. All right, so let me start with the bank and make the adjustment for the bank. $9,850 for the bank, and included a $150 charge for annual business account fees. Okay, this fee, so I don't need to adjust the bank. The bank already knows the fees. Deposits in transit, $5,000. I made the deposit. The bank doesn't know about the deposit, so I need to add that to the bank. $5,000. Add it to the bank. Okay. $5,000 added to the bank. $14,850. Outstanding checks. This is a check that I wrote the check, but the bank has not seen it yet. When I say the bank has not seen the check, it's not a deposit. It's money that I pay other people that will be coming out of my bank account. So minus 1,000. So here we have 13,850. Non-sufficient fund check received from customers, $750. The bank has already seen that. It has not been adjusted in the books, but the bank knows. The bank has reported that, so it's been reported already in the 9,850. So I would have 13,850. Let me see if I have something like that. 13,850. If this is for the bank, right? This is bank adjustment. This is bank adjustment, bank statement adjustment. They're asking me for cash on December's balance sheet. Now, since I have already reconciled the bank, I don't need to reconcile the book. This is exactly what it is. Excellent. I don't need to reconcile the book unless there is something extra that I need to do in regards to the book. I will do it, but if you already find the bank has to be balanced, this is what they call it, reconciliation. I think this chapter is not too bad. This chapter is very good. Don't say not too bad. Chapter is very good. You can breeze through this chapter. Breeze through it. When you find them like this, do them quick, because this thing, man, has a lot of questions. We have a lot more questions to do. Okay, cash and cash equivalents. I have 17 more questions left. Cash and cash equivalent. After that, we'll be doing trade receivable. I should be able to complete all of these questions today, but I'm feeling a little tired. What time is it? Wow, it's almost 11. 10:49. Okay. So I think, let me see if I can take 5 more questions before we leave. 5 or 7 more. Let's take 7 more. What time is it? 10 minutes. All right. If we could take 7 more questions, we would have 10 questions left. We do them tomorrow. We're doing tomorrow, God willing. The company's monthly bank statement shows a balance of $37,500. Reconciliation. Remember, here they're talking about bank statement, not book or balance sheet. Okay. Bank statement shows a balance of $37,500. Reconciliation of the statement with company books reveals the following information. Bank service charge, $25,000. Insufficient funds check, $550. Outstanding checks, $3,000. Deposit in transit, $2,750. Bank error included, extra deposit, $200. Check deposits by the company and cleared by the bank for $527, but improperly recorded by the company as $572. What is the net cash balance after reconciliation? Again, here there is no extra reconciliation. They're asking me for cash, but cash balance on the books, but they are giving me bank statement information. The first thing I'm going to do is to reconcile the bank statement. Once I have the bank statement reconciled, I do have, so it should be equal to the cash. So I don't need to find other formulas to resolve the cash balance. Okay, let's go. We start with $37,500. And then we have bank service charge, $25. Bank service charge is already on the bank side, so we don't need to adjust that on the bank statement. Insufficient funds check is $550. The bank already knows that, so they have already reported that. Outstanding checks. This is what the bank does not know. I have written a check. To pay a customer, but the bank has not deducted that money from my account. So now I need to deduct that money from the $37,500. $37,500 minus $3,000. $34,500. Deposit in transit. I made a deposit, which I have already reported in my books. But guess what? The bank has not seen that deposit. So what I have to do is to add it to the bank. You add, because it is a deposit. It's not a subtraction. It is an addition. $2,750. $37,250. Bank error included extra deposit. The bank made an error. If the bank made an error, the bank will take care of the error, but the bank has not seen the error yet. So we need to subtract this. Subtract the $200,000 because it is a bank error. Minus $200. Minus $200. There is something else. Check deposited by the company and cleared by the bank. All right. So the bank has cleared it already. It's $527. Improperly recorded on the book. I'm not working with the book right now. I'm working with the bank. So if the bank has already reported it, that's cleared. That's it. So what we have reconciled for the bank is $37,050, which should be the same for cash balance. $37,050. And let me see if this is correcto. Yes, this is correct. Excellent. Star Corp had the following accounts and balances in its general ledger as of December 31st. General ledger is the balance sheet. Isn't it the balance sheet? Is the books. Yes. Petty cash, $500. So we're talking about the books now, not bank statement. Always need to remember that. Petty cash, $500. XYZ Bank checking account, $20,000. Marketable equity security, $10,000. Marketable debt security, $7,500. ABC Bank depository account, $5,000. What amount should Star report as cash and cash equivalent on the balance sheet as of December 31st? Cash and cash equivalent. Petty cash is cash, $500. Checking account is cash, $20,000, so that's $20,500. Marketable securities. Marketable equity security. That should be cash equivalent because you can market it, you can sell it. But it doesn't say short-term marketable security. I would say $30,500 because that's 10,000. Marketable debt security. Marketable debt security. I gotta find some help with this. I need to understand you. I need to understand that. Let's do it. Let's do it. All right, StarCorp had the following accounts and balances in its general ledger as of December 31st. Petty cash, $500. XYZ Bank checking account, $20,000. Marketable equity security, $10,000. Marketable debt security, $7,500. ABC Bank depository account, $5,000. What amount should Star report as cash and cash equivalent on on the balance sheet as of December 31st? Tell me now. Yes. The key is to identify which items are actually cash or cash equivalent. Yes, petty cash. XYZ checking account, 20,000. ABC Bank depository. These are cash. These are all cash. Exclude marketable equity security. Stocks are never cash equivalent because their value fluctuates. Really? Marketable debt securities. Unless the question specifically tells you they mature within 3 months of acquisition, do not assume they are cash equivalent. Okay, makes sense. So, marketable security, marketable equity security, marketable equity securities, stocks are never cash equivalents because their value fluctuate. Short-term marketable debt securities. Equity security is never cash equivalent. Debt security could be cash equivalent if maturity date is in 3 months or less. That's what you gotta know. $25,500. Okay? This is what you gotta know. Petty cash is cash. XYZ checking account, 20,000 checking account is cash. Marketable equity security, no. Marketable equity is never cash equivalent. Marketable debt securities could be. If it was a short-term marketable debt securities, you would be, yes, this is cash equivalent. But never assume if it doesn't say it. Bank depository. Oh wow, it's already time. 25,500. It's already time, everybody. It's already time. We're going to stop right here. We'll come back tomorrow. We can complete this. We can complete this tomorrow, God willing. Thank you for sticking around. This was amazing. Wow, it's already 11. Okay. Have a great day, everybody. God bless.